In this video, I want to share with you why gold is the ultimate mind game in Forex trading, and I'm going to do it in 3 points. Let's get straight into it. Point number 1. Welcome back to Gains in Mindset Age. This is the place where we come to find out why stock markets have been crashing lately. What's up, my friends? If you are new here, then consider subscribing. It's absolutely free, and we would love to have you part of the family. And if you're a family member already, well then what is up, my friends? How was your weekend? Hope it was good. Hope you had fun. And if you didn't have fun, well then next time. But in any case, let me remind you something very important. And it is the fact that there is a live stream that runs through the week. We have it right over there. So make sure you take advantage of it. It runs from Sunday to Friday when the Forex market is open, and you can join us live and ask questions and trade along with us. It's absolutely free. You don't need to pay for it now or in the future. All right, let's get back to the topic. So point number 1. Why is gold the ultimate mind game? Well, first of all, let me define what a mind game is, because I think in order to understand why gold is the ultimate mind game, you need to understand what exactly is a mind game in the first place. Well, a mind game is a method used by traders to influence the psychology of their opponents or trading partners in order to gain an advantage in the market. Now, you may be wondering, well, isn't that like manipulation or something shady? Well, not necessarily. In fact, many successful traders use mind games as a way to improve their trading performance without resorting to unethical or manipulative tactics. It's all about reading the market and understanding the psychology of the other traders. And when you're dealing with gold, oh man, you're playing a whole different game. So let's talk about what happens with gold every day, every single day. The London Bullion Market Association, which is a global organization of bullion dealers, publishes the daily gold price fixings at 10:30 a.m. London time. Now, what exactly is the gold price fixing? Well, it's a process of setting the official price of gold for the day. The price is determined by a group of participating banks and bullion dealers who submit their best bid and offer prices. The average of those prices becomes the official fixing for that day. Now, this is where things get interesting. The publication of the gold price fixing triggers a cascade of reactions in the market. Traders who have positions in gold or related assets start closing their positions, taking profits or cutting losses. Some traders even go short on gold, anticipating a decline in price after the fixing. However, sometimes the market doesn't react the way these traders expect. The price of gold can suddenly surge or plummet, leaving those who went short scrambling to cover their positions. And this volatility can create huge profits for traders who are aware of the psychology behind it. That is the mind game. You see, once the fixing is announced, traders start closing their positions based on their current profit or loss. Those with unrealized profits will set their stop losses somewhere below the market price to secure their profits. On the other hand, those with unrealized losses will move their stop losses to break even to avoid further losses. This behavior creates a domino effect, where traders are forced to close their positions based on their individual risk tolerance and account sizes. And that's when things get crazy. Think about it. If everyone closes their positions after the fixing, then there would be no one left in the market to buy or sell gold. The market would simply collapse. But in reality, the opposite happens. There are always traders who didn't enter the market before the fixing, and they start entering now, either because they believe the price is undervalued, or because they want to take advantage of the volatility. These new entries create new stop losses, and the market starts moving in the opposite direction. It's like a never-ending cycle of stop hunters and volatility. And the most successful traders are the ones who can read the market and predict its movements based on the psychology of the other participants. All right. Second point. Why is gold the ultimate mind game? Let's talk about something that happened recently. A couple of days ago, several stocks experienced a significant drop in value. For example, Tesla stock dropped by 6.78%. Netflix dropped by 4.9%. Amazon dropped by 3.9%. And Google fell by 3.7%. Also, crypto prices dropped significantly, with Bitcoin falling by 6.3%, Cardano by 12%, XRP by 13%, and Solana by 11.8%. Now, I'm not going to pretend that I know exactly what caused these drops. There could be various reasons, from macroeconomic factors to changes in investor sentiment. But I do want to highlight a specific aspect that caught my attention, and that is the role of short sellers in these market movements. You see, Short selling is a trading strategy where traders borrow shares of a stock that they believe will decrease in value, sell them on the open market, and then repurchase them at a later date for a profit. If the stock price indeed decreases as anticipated, then the short seller can buy back the shares at a lower price than they sold them for and pocket the difference as profit. However, if the stock price increases instead of decreasing, then the short seller has to buy back the shares at a higher price, which results in a loss anyway. According to financial news websites, short interest in Tesla increased by 19% since the beginning of the year, meaning more traders were betting on Tesla's stock price to fall. Similarly, short interest in Netflix has also been on the rise since the beginning of the year. And guess what happened? Both stocks saw significant drops in value recently, leading some people to believe that the short sellers were responsible for these drops. However, we can't just blame the short sellers for causing these drops, because it's not that simple. You see, short selling is a normal part of the market, and it helps to ensure that prices reflect the true value of a stock. Short sellers provide liquidity to the market and help to reduce volatility. In fact, studies have shown that short selling can actually lead to higher returns for investors. So it's not necessarily a bad thing. However, when short sellers become overly pessimistic about a company's future prospects, it can lead to a self-fulfilling prophecy where the short interest drives the stock price down and the company's fundamentals deteriorate as a result. This is known as the short squeeze. So the real question is, are the short sellers right about Tesla and Netflix? Or are they just overly pessimistic? Only time will tell. Now let's move on to the third point. When we talk about the ultimate mind game in Forex trading, we can't ignore the impact of overall market sentiment. Market sentiment refers to the general attitude of traders towards the market at any given time. It can be optimistic or pessimistic, and it can have a significant impact on the market's direction. For example, during the COVID-19 pandemic, the market sentiment was extremely pessimistic, and the stock market crashed. However, as the economy started to recover, the market sentiment became more optimistic, and the market started to recover as well. Similarly, during the recent conflict between Russia and Ukraine, the market sentiment was pessimistic and the stock market crashed again. But as the conflict started to de-escalate, the market sentiment became more optimistic, and the market started to recover again. You see, market sentiment is driven by a wide range of factors, including economic data, geopolitical events, natural disasters, and even the weather. For example, if the economy releases positive data, such as strong GDP growth or low unemployment rates, the market sentiment tends to be optimistic, and the market rises. On the other hand, if the economy releases negative data, such as weak manufacturing activity or declining consumer confidence, the market sentiment tends to be pessimistic and the market falls. Geopolitical events can also significantly impact market sentiment. For example, the recent conflict between Russia and Ukraine caused a lot of uncertainty in the markets and led to a significant drop in prices. However, as the conflict started to de-escalate, the market sentiment started to improve, and the prices started to recover. Even natural disasters and weather can impact market sentiment. For example, during the COVID-19 pandemic, the extreme weather conditions led to the closure of businesses and the cancellation of events, which in turn impacted the economy and the market. Understanding market sentiment is crucial for traders because it can help them to anticipate market movements and make informed decisions. For example, if the market sentiment is optimistic, traders may be more likely to buy assets, while if the market sentiment is pessimistic, traders may be more likely to sell assets. However, it's important to remember that market sentiment can change rapidly and unexpectedly, so traders need to be prepared for anything. So, now you know why gold is the ultimate mind game in Forex trading. It's all about reading the market and understanding the psychology of the other participants. Thanks for watching, and until next time.